We had two hawkish comments, not only from Jim Bullard, but from Esther George. Is this a timeline problem? So if you want to make sure that actually you can work with interest rates, tapering needs to come soon, no matter really what happens with inflation.
Well, I think the important thing as you talk about interest rates and the Fed is recognizing how different the world we're in today than the world we've mostly experienced. And when you think about interest rates, it's really not the private sector driving interest rates, reflecting economic conditions. It's much more what policy do central bankers want to have happen? Even so, they move from controlling short rates to controlling short rates, and to some degree controlling long rates, and also to some degree controlling corporate spreads. So when you think about the policy they're trying to drive, the big thing that's going to drive bond yields is when this what we call MP3 policy, the fusion of monetary and fiscal policy, creates outcomes that the central bank no longer desires. And that's where we sort of are. Right now, they can control the interest rate and through fiscal policy, in a sense, control nominal GDP. But there are consequences. And the consequences are higher inflation. The consequences are bubbles. And the consequences are eventually currency risk. And you're 2 out of 3. There's certainly some bubble activities in different areas of financial markets. There's certainly inflation well above their target, and we think it will continue to accelerate if the Fed doesn't move. And the third thing, eventually, as you get these types of policies, you'll see more currency volatility. So that's, I think, what the Fed will be watching. That's certainly what we're watching. And as a result of that, we expect the tapering to be faster than markets are currently expecting, rates to actually rise faster than markets are currently expecting, because the economy is going to pull the Fed. So despite the fact that the Fed's going to be record easy, the economy is going to pull the Fed gradually.
Okay, so in that case, what do you need to be buying in equities? I was struck then 13F filings, the recent additions were all the safety guys, J&J, Procter & Gamble, Pepsi, Coke. Relate the two together for me.
Yeah, well, I think the biggest arbitrage you can sort of take in the world right now is take what the policymakers are giving you. They're giving you incredibly low interest rates relative to high nominal GDP growth. And so if you can hedge that, if you can essentially take in cash flows that will move something like nominal GDP and hedge, being short treasuries or other instruments that allow you to hedge the risk. The main risk is that the Fed has to tighten faster than people expect, that the liquidity that has supported asset markets and created bubbles will have to be withdrawn. Now, some equities, the equities that really have cash flows and earnings driven by nominal GDP, should be okay. The assets that require constant liquidity infusion because they don't actually, they're not profitable, they're not themselves able to create the cash flows to support the asset prices, but require more and more liquidity in financial markets to hold those asset prices. That's where we'd be nervous about those equities and more bullish on the equities whose cash flows will be driven with the continued strength in nominal GDP.
Greg, how do you look at the Delta variant, right? So we're monitoring closely. I'm sure the Fed is. But if the Delta variant gets worse, can the Fed still withdraw liquidity without derailing the economy? Yeah,
well, this certainly slows the timeline down to a certain degree. I think overall we monitor, and I think the data on mobility suggests that many economic participants are willing to get on with their lives and are still moving around. It is a negative. It does slow the timetable. You're seeing it to a certain extent in the economic stats, but the bigger picture direction appears clear that one way or the other, we're going to live with the virus. The vaccines are working to lower the death rate. The economies across the world are coming back online. The U.S. is leading because its fiscal policy has been so extreme, but the rest of the world is lagging and following. And that's occurring despite the difficulties that the Delta variant and probably future variants will cause. So it matters. It certainly affects the timeline of these decisions, but it's not, in our view, changing the fate and the likely direction.
So, Greg, that kind of leads me indirectly to China, because China seems to have adopted a zero tolerance policy, which has really put the government in somewhat of a bind. I mean, we saw today in one of the papers that sort of fronts what the government says, that they're going to keep pumping credit into the economy to help support it as they have this zero tolerance policy. That's one hand. On the other hand, you have this regulatory crackdown in big tech and other sectors as well. How do you play China with those two things in mind?
Yeah, well, I think when we watch China, what we see is them balancing several very important things: common prosperity, the fact that they want to change the distribution of income. At the same time, they're trying to build their financial markets and want global investors they recognize to be a superpower. You must have viable financial markets. So it looks from an outside perspective often like, oh, they're moving away from the desire to shift towards financial markets, but it's more balancing multiple goals simultaneously. And when you look at their history, they've generally successfully handled multiple goals simultaneously, and we expect that's the most likely scenario today. And with the variant, I think it's important across the world to say, if the variant gets worse, what will happen with policy? Just like you mentioned the China case, but this is true in the US or whatever, that what'll happen. There'll be easier monetary policy and fiscal support if the virus gets worse. So actually the biggest risk to markets is less that a downturn, because we know how policymakers will respond to that. It's much more that inflation and bubbles create a need for the central bank to tighten faster than people are expecting. That's actually a much more significant risk that needs to be hedged, because policymakers will ease if necessary with respect to the virus.
Greg, is there anything actually in the China space right now, Chinese equities, that you would be buying?
Yeah, overall, I mean, the big thing in Chinese equities is we think so many people are underexposed, that the reverse is basically the problem we see the most, which is everybody is overexposed to U.S. assets. U.S. assets are the most expensive, probably face some of the biggest challenges around the liquidity policy being withdrawn the quickest, and inflation challenges. So when you look at that, and you look at how essentially 60% of global investors' portfolios are in U.S. equities that make up something like the U.S. makes up about 25% of the global economy. You reverse that and see global investors have something like 5% of their assets in China, where China makes up almost an equivalent amount of the economy. There is this huge mismatch that we do expect a decade from now will be reconciled one way or the other, and that in the short term, of course, there's all these challenges in the relationship between the U.S. and China, and that will be ongoing as well. But the big deal is the difference in asset prices reflect the risks in China, we think. The asset prices in the U.S. actually reflect very, very low risk premiums. So probably a little bit more dangerous than assets outside of the U.S.